welcome to the Titans of Industry show. Thanks for joining us today. We're doing something a bit different because we have David Truangle with us from TradeTours.com. And what I want to stress about this guy is that he's an expert short-term trader. And I wanted to introduce you through David to the world of short selling at length today. David, how are you?
I'm doing all right. How about yourself?
Hey, I'm very good, and I'm glad you can come on the show. So, what is short selling, and why is it an important tool for traders and investors?
Well, it can be very effective depending on what type of market we are in. Okay, so first of all, the traditional definition of short selling would involve borrowing shares with the promise to return them in the future. And the idea is that you are hoping whatever security that you are short selling, you want it to go down in price because that way you can buy it back at a discount and return those shares and pocket the difference minus, any costs or interest that you had for borrowing. So I guess the simplest way, this may sound like a corny example, but I want to keep it really, really simple. Suppose that you had to watch your neighbor's house for 6 months, and you went to their garage and you sold a gallon of gasoline for $2 without them knowing. So you made $2, but you have to return that gallon of gas. Well, suppose the day before your neighbor returns, gas fell to $1. You could go buy a gallon of gas for $1, return it, so your neighbor isn't at any loss. They have what they had in there before, and you would pocket the $1 difference, if that makes sense. Kind of a cheesy example, but I like to walk through some of the simpler ideas so people know what I'm talking about.
Yeah, sure. And let's keep on with that idea. So a short selling position would require one trade to borrow and one trade to buy back? Or is it a one trade scenario and everything that you said is being done within that trade?
Yeah, it depends exactly how you do it. I trade with Charles Schwab, Options Express. They traditionally want margin or leverage to do it. But as far as, you may have been looking at my website too. When I sold short, technically the term going short means you're betting on something to go down in price, right? So I'm actually more of a fan of doing put options, which is borrowing, or you're actually locking in a contract that gives you the right to sell a security at a given price. And you're paying a premium for that. That way, your risk isn't unlimited, because if you borrow something and the price moonshots, technically the sky's the limit as to what you could lose. So put options are something that would be, more geared towards a beginner. I don't actually borrow the shares. It's something I haven't done in a long time. When I did it on the silver market when the commodity market melted down really from 2011 through 2015. And most of it was actually through put options on the ETF SLV, which I know a lot of your followers are familiar with. Looking at some of your interviews, you talked about the paper share meltdown, the manipulation and all that. So a lot of what I did involved put options. That way, if I'm wrong, I'm not going to lose my shirt. The most I lose is the premium. When you are buying options, though, when you are going short, again, I always try and steer people away from buying things that are way out of the money. So if you're going to buy a call, don't try and gamble because the premium is cheap and buy something that's, way higher than what the market value is. Conversely, if you're buying a put, don't try and buy something that's way, way less than the current price. So stay in the money if you're going to do it. And that's the way that I personally like to trade options.
Sure, and we'll do a follow-up interview on options because that's far more advanced. But let's stick to the basics of understanding the short selling. Why is it an important tool for traders and investors? Do most investors use short selling for in their day today as a hedge instead of being net long everything?
Sure. So, the reason where it can kind of supplement your trading career and help you, and why it can be important, is basically it allows you to make money if the market's going down. So your traditional trader, they're kind of stuck to one side of the trade. They'll make money if the market goes up, but somebody who can short sell, you can profit as the market goes down. And then, of course, if it goes back up, you can enter a long position. So it really allows you more flexibility than anything else. It's not that, though, everyone has to do it. In fact, it's only the type of trade I would recommend for a select few that are willing to accept some more risk. So as far as hedging or trying to limit risk, if you think the market's going to go down, the simplest thing to do is just to get out, right? So exit your position, You don't have to try and get too technical and profit off of every move, but that is a possibility for those that are, more advanced in the trading world. So again, it just basically allows you to do well because, if you look at whether it's gold, silver, or the Dow Jones, I mean, markets move in cycles. They go up, they go sideways, they go down. But there is just as much money to be made, and there is potential to be made on the way down as well as the way up. So I guess if you time everything correctly, the reward is more profit. Okay, you can have bigger gains. Obviously, the trade-off is you're taking risk.
David, the short selling community has received bad press, bad reputation over the years. Is this justified in your opinion?
It can be. Again, it all depends, though. It all depends on the individual and what their tolerance for risk is. I think that's the most important factor. So I don't recommend that everyone short sells at all. I only would advise that if you are willing to accept the risk and depending on what market you're going to do it on. That's the most important thing. If you look at the Dow Jones, for example, if you just pull up whether it's a 10-year chart, a 100-year chart, or look at the long-term trend, short selling paid off very well during market recessions, but in the long term, those that attempted to do it, over the long haul, they got burned, right? So betting against some of these American giants, trying to short them long term usually isn't a good play. It has to be done more in the short term, okay, and that's when you can clean up the most profit. So again, as far as the reputation being questionable, it's hard for me to give you a black and white answer on that. It depends. But I would certainly say if anyone listening to this has doubts or they don't think it's right for them, don't do it. Only make the investments that you're comfortable with after doing research and know exactly what your risk and reward is going into every trade.
Sure. No, I more have meant, David, that the short sellers, some of the famous ones, have had a bad reputation because they're cheering for companies to go down in price. And do you think that's justified? Do you think short selling is immoral in our day and age, or do you think it's a legitimate trading vehicle?
Well, again, I mean, it's kind of a loaded question. I think, though, the market, I don't really consider it immoral. I mean, if you are investing in a share of a stock or whatever it is, or whether it's commodities or futures, usually, unless you're collecting dividends, which would be an income, that's coming directly from the profits of the company. If you're going to invest in shares of a stock, understand that you're planning to sell that to someone else at a higher price. So your gain effectively is going to be someone else's loss. So in the world of short selling, it really is a dog-eat-dog world. And no, I wouldn't really consider it immoral or unethical, because in order to make money in financial market speculation, someone else is going to be losing somewhere. So again, the idea of zero sum is something I've discussed before, but it really is a dog-eat-dog world, and it is a free-for-all.
Well, the best sentence ever made about the stock market is it's the best way to move money from the uneducated to the educated, and I think that is all the stock market was, or ever will be. Now, David, I want to ask you this: what kind of companies do you short? Not the tickers themselves, but what I'm asking you is, do you short overpriced companies, or do you short expensive companies? Do you short companies that have obsolete business models, or do you look for fraud, accounting fraud, other types of fraud, misinformation, etc., where it's going to come back to bite them, or do you short on a more technical analysis type mentality?
That's a really good question. Most of the shorts that I would do, it would be done on a technical level. Okay, now you can target certain sectors, and I would be more willing to short an industry or a company that does not have the long-term sustainability. It doesn't have the track record of earnings. I think that the smaller companies that would be more likely to fail, whether it's a high flyer tech or something that I guess doesn't really have like I said, the sustainability. So I wouldn't be a fan of shorting something like McDonald's stock. Okay, that has a track record of being around for so many decades, paying out a dividend. It's a monster corporation that here in America, we have a lot of people that are obese. They love to consume cheeseburgers. It's a pretty smart, effective business that's probably going to be around for a long time.
60% of McDonald's is already outside of the U.S., so everywhere in the world, people love their
there you go.
McFries and
Right.
McNuggets.
You talk about a company that's been expanding, over the long term, and like I said, there would be a lot more that would have to go wrong in order for that company to come down. But some of maybe the smaller players or an industry that you or I don't agree with, and then that in conjunction with the trend going downward. So to answer your question, it's more technical than anything else, but I do like to look at the long term business fundamentals to get an idea of, hey, do I think this company is going to fail? But like I said, if you are shorting more on the, over the next few weeks or month or two, you can still make money on larger companies that go down because there's always volatility in the marketplace. But again, I just would prefer to short something that doesn't have the long-term track record of earnings and going up in price.
Okay, so earnings is one thing. You look for smaller companies, maybe they don't even earn anything. They're more in startup mode. What else do you look for?
And you got to be a little careful on going too small because, a lot of the smaller companies may not have the shares available to borrow, or the option chains may not even be existing. But the main thing, though, it is technical. So again, the technical trend, I think, is really what shows you what's happening. So again, looking for something that is near a 52-week low, maybe it rallies and you identify some further weakness. Hey, the trend could go down again. Looking for moving averages, support and resistance levels, pretty much technical tools that I talk about at my website, tradertours.com, because again, the trend is showing you what investors are doing with their money. If a share price or a stock is going down, people are selling, the demand isn't there. If something is going up in price, that is representing the literal actions of what people are doing with their money, what investors are buying. So again, that's why I love technical analysis, and it's really been the genesis, again, for my business model and my own personal portfolio.
Okay, very well. Now, what else can you share with us, with regards to some simple trade techniques that can really help people be less stressed about their investing and more cautious and more profitable?
Sure. You could certainly use a stop loss, which would be an automatic trigger to sell your shares. So, if you have let's say a stock that's selling for $100 a share, in theory, sure, the stock could go to zero. So the most you could lose is 100% of your investment. But maybe you implement a stop loss at $90 per share. And therefore, you're really restricting your loss to about $10 per share or 10%. That way, if you're wrong, it's not going to be devastating. But again, you shouldn't be investing with any amount of money where if you did lose everything, it would be devastating regardless. So stop losses are one thing. But again, it all depends on the marketplace and where we're at today. Right now, for example, I'm more of in a defensive dividend mode. I've talked about this with my subscribers as well as throughout some other videos out there. So one strategy you can do, especially if you're more of a fundamental type person, is, buy something and hold it that is paying a consistent yield, right? So you're getting that paycheck every 3 months. Recession-proof companies, like I said, I mentioned the McDonald's. There's a lot of big ones out there like that you don't have to get too fancy to get paid. You don't even have to have a very well-versed head on your shoulders in the world of trading, where you can do okay just by buying and holding the thing. And this comes back to analyzing the long-term charts and really identifying some of these patterns. So stop losses, dividends, and then most importantly, like I said, analyze the trend, right? Use moving averages. Another thing that's kind of hard to explain over a call like this, but I have a lot of emails and videos that I do that breaks it down. That will show you, again, where the stock or commodity is heading right now, as well as where it could currently be going in the future. So the idea is that when you look at a chart, if something is at a 52-week high, movement is generally followed by more movement in that direction.
Interesting. By the way, on the stop loss front, do you recommend people put that order in or just have it in their head so they can use it when the time comes? Because many investors have complained that the companies that they work with use their stop loss orders against them because they know where the threshold is.
Absolutely. Another great point. That is something that you have to be careful of because, if it's known information by them, they can bring in some players to sell that would get you stopped out. So a lot of it depends, I guess, on where you put your stop loss. So you could kind of go either way on that. I mean, as long as you have, I guess, an exit strategy, that's the most important thing, is to know when or where you're going to get out, okay, before you're going into the trade, because that comes back to the risk factor. But I would say that if you're going to do the stop loss, you could pick a point that isn't exactly under a support level, because that's what a lot of other traders might do, and that could trigger sort of the chain reaction. But again, it ultimately depends on the market and how you want to put it. I mean, I've done trades where I had the stop loss physically put in, but other times I sort of have a mental price number where I would sell out. So it kind of depends on the market.
David, could you please tell people a little bit about what's going on with your website and your products?
Sure. Yeah, tradertours.com. Bottom line, I specialize in online training for investors dealing with securities, stocks, pretty much anything related to financial markets. I have a newsletter that's sent out via email, as well as a home training course. And the nice thing about the course is it is geared towards people that have experience as well as don't have any experience. So I tried to cover as much as I could. There's a technical workbook on everything from how to set up an account to how to place a trade to what specific patterns to look for. And then there's also a couple of DVD packages that you'll receive as well, so that way you can kind of get the visual and see some live trades. So it's really a package of information that helps people learn how to trade about the financial markets, learning the ins and outs, learning about some of these strategies. Options are explained, obviously, on a much greater level in the book. So there's a lot of good resources for investors to use. And if you do invest in the home training course, you also have access to, you can actually become an affiliate and get compensated by marketing the course if you like the material. So that's sort of an open-ended option for subscribers if they like the content that I do. So some people are taking advantage of that as well.
David Truangle from tradertours.com. Thank you very much for taking the time today.
Thank you, Laura. Have a good one.